What is so unique about SCHD, and how does it fit with most modern portfolios? In an investing world that's gone wild for low-cost index investing and growth or aggressive growth portfolios, the funds that dominate headlines tend to all be very similar. Whether it's QQQ from Invesco, which is a Nasdaq 100 fund, VOO from Vanguard, which is an S&P 500 fund, or something more broad like a Nasdaq composite fund from Fidelity that carries all the Nasdaq. They're all growth and aggressive growth funds, loaded on the front end with the same or similar stocks from these massive companies. If we look at these three funds in more detail and try to find differences, we soon find out that they're not really very different. If we compare them, we can immediately cross off Microsoft, Apple, Amazon, Nvidia, Alphabet Class A and Class C, which is just Google's parent company, Meta, and Tesla before we get to any kind of deviation between them all. They're mostly uniform with some differences for weighting and a few slightly different holdings the further down we go. So if those aggressive growth, tech-heavy funds are all the rage, why is SCHD being called a bellwether ETF and the ultimate sleep well at night fund that could serve as the cornerstone of your portfolio? Why does Morningstar think so highly of it? How does SCHD compare to the S&P 500? To save you time, I've read through the entire fund prospectus so that you don't have to. I know what you're thinking. I must hate myself to volunteer for that. I'll cover what investment style it is, what index it's benchmarking, what kind of dividends you can expect, a rate of return, and companies you'll be investing in. All that and more coming up now. Hey folks, I'm Daniel. Let's go. SCHD is Schwab's Dividend Equity ETF. If you're not familiar with Schwab, they have a large selection of investments to choose from and $750 billion in assets under management. Of those investments, SCHD comes in third behind their money market fund and their S&P 500 fund in total assets invested at around $46 billion. To understand SCHD, you first have to understand that it's an index fund. You cannot invest in an index, but understanding the benchmark or the index will help you understand the fund. Kind of like paying Microsoft for a license to use Microsoft 365 products, Schwab pays a license fee to S&P Dow Jones to be able to have access to their research and analytics to help them weigh the fund properly. Here we can see that it's indexed to the hit the like button, which is completely free and not at all complicated. But seriously, it's indexed to the Dow Jones US Dividend 100 benchmark. If we jump over to the S&P Dow Jones website, you can explore the index in greater detail. We can see that the index launched in August of 2011 and that the index has a return of about 7.5% at the time of this video. But that's the index, not SCHD. They have only 4 equities that are benchmarked to this index and 3 are in South Korea. The only domestic fund index to this is SCHD. Although it's benchmarking the Dow Jones US Dividend 100 index, it does not perform identically to that index. The reason for this is because they apply their own rules to further craft this specialized ETF into a fund that generates higher returns. Per Schwab, the goal of SCHD is to invest in high dividend yielding stocks issued by US companies that have a record of consistently paying dividends, and the companies chosen are selected for their fundamental strength relative to their peers. To qualify, there are several filters. First is that all index eligible stocks must have sustained at least 10 consecutive years of dividend payments and have a minimum market capitalization of $500 million. They must also meet certain liquidity requirements. Once they pass through this first filter, they then look at 4 fundamentals including cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. To further tighten their standards, no single stock can represent more than 4% of the index, and no single sector can represent more than 25% of the index. So here's where SCHD deviates from the index sum. Their stated goal is to invest at least 90% of the net assets into these stocks. They're giving themselves some flexibility here to adjust as needed based on the circumstances and subject to the discretion of the fund manager. Using an index doesn't mean you have to follow it perfectly. In fact, they come out and say that their goal is to match the index with 95% correlation. So what does that at all mean? If we look at their top 20 holdings, it makes up 72% of the total portfolio. The top 9 holdings are all greater than 4%. If you recall, their stated goal is to have no single stock weighted greater than 4%. This means that these 9 stocks have appreciated, and their next rebalancing is likely going to include them attempting to shift the weight of the portfolio sum to try to get these all down to 4% or lower to meet the stated goal of the fund. fund. They're sticking to their goal of no single sector exceeding 25% of the portfolio. With SCHD, you can get industrials, healthcare, consumer staples, financials, information technology, energy, consumer discretionary, communications, and materials with a little utility sprinkled in. So remember that chart I showed you earlier about how much overlap there was between QQQ, VOO, and the Nasdaq fund. Although SCHD does have Pepsi and Broadcom in it, it doesn't have a single stock that's in all three of the other funds' top 10. That's because its investment style is different. It focuses on large value. What this means is that they're heavy in big companies that aren't as expensive as the Teslas or the Microsofts. These companies might not grow quite as quickly, but they tend to be extremely reliable and predictable with strong cash flow to match that lower volatility. They do have less than 20% in mid-cap, small-cap, or micro-cap. Because these companies are predictable and have steady cash flow, their dividends are solid. Here we can see SCHD is hovering at around 3.6% on an annual dividend yield. Their dividends are paid out quarterly. That's a great dividend, not even factoring in capital appreciation. Something to keep in mind is because they exclude real estate investment trusts and other non-qualified dividends, the dividends qualify for capital gain taxes instead of ordinary income tax. This dividend has grown 16% and the payout ratio is healthy at 56%. A payout ratio is simply the dividend divided by the earnings per share. If you have a $1 dividend and $1 in earnings per share, that's a 100% payout ratio. This is not healthy because it means everything earned is being paid out. A good rule of thumb is to stay at 75% or below, which they've succeeded in doing here. So how has SCHD performed from a growth perspective? Since its inception, October of 2011, it's averaged 13%. It's down 0.5% over the past year, and year to date it's down over 3%. In the past decade, it's had annual returns that exceeded 30% once, twice it's reached the high 20s, 3 times it's hit the teens or low 20s. It has dropped in value twice. Its best quarter was 17% in gains, and its worst quarter was during COVID when it dropped over 21% in Q1 of 2021. Here you can see that over the past 10 years it's tracked very closely to the S&P 500 with an annual return of about 11%, which is slightly less than the S&P 500's 11.65%. We can see over the years it's tracked very closely but has less volatility. It's also important to keep in mind that this is a chart of capital appreciation and doesn't include dividends. Many of the companies in the S&P 500 pay a small dividend, but I find it impressive that SCHD can pay such a healthy dividend and still come so close to matching the S&P. On your investment, you'll only pay 6 basis points, which is very low. To put that in perspective, in the 80s and 90s, it wasn't uncommon to pay somewhere between 1 and 3%, which is 100 to 300 basis points. The average was about 73 basis points. 100 basis points equals 1%. On an investment of $10,000 in SCHD, you'd pay $6 for the year. This is an awesome expense ratio. If you're looking to compare it to its competitors, take a look at Vanguard's VYM. There are a ton of similarities between these two funds. They're both large value funds with a focus on high dividend paying companies, and VYM's dividend is roughly the same as SCHD. They have the same expense ratio at 6 basis points. If we go back 10 years, you can see that they start fairly close together and follow the same growth trajectory. As time goes on, SCHD does start to pull ahead and stay ahead. Once again, SCHD really does hold its own against the competition. As far as whether I recommend SCHD, YouTube is full of people giving stock picks, but I'm not a financial or fiduciary advisor in any capacity. It would be inappropriate for me to make a recommendation to you directly, even if I knew your situation. If you want financial advice tailored to you, I recommend a fee-only advisor, that is a fiduciary. A fiduciary is simply someone who is legally and ethically obligated to put your interests ahead of their own. With that being said, I can give some broad statements about this ETF and you can make the decision for yourself. This is a solid fund invested in established, large, stable companies. So far, it's been able to deliver a combination of solid returns, and that has been greatly complemented by a really healthy dividend. It won't have the aggressive spikes in the bull markets like the growth funds I mentioned at the beginning, but it's absolutely complementary with a little less volatility while still giving you that exposure to those blue chip companies. If your portfolio is heavy in the growth or aggressive growth and you want to pull back a little due to volatility, or you're just looking for a large value fund, SCHD might be a good fit. Folks, that wraps it up for today. Let me know in the comments if you own this ETF or if you intend to start investing in it. Till next time.